Subscribe, like, and share this video content. Approximately 1/4 of investors experience loss in a stock market that affected their portfolio. That number is much higher, especially with the most recent market correction that we have all experienced recently. With the most recent market volatility, investors are apprehensive to invest any more in the market at the moment, and as a result become risk-averse. Reaction can take one of two forms: not doing anything at all, or reacting from emotion. It is perfectly normal to avoid losses, so getting out by selling an investment may seem like it's the right choice. What can be done after losing money in the market? But doing your due diligence and identifying quality stocks is the best way to get back into the market, especially after a recovery. Losing money should not influence the search for another venture that can serve you well when planning for the long term. Should you buy back into an investment that rebounded? Watching that investment you sold at a loss rebound can be painful. Which means you fell into the trap of panic selling and looking to buy back during the recovery or upswing. Panic selling is an emotional gut reaction when the market is going down and your portfolio has lost some valuation. As a result, investors end up losing money on every cycle of trades. If you are going back into the market with the same investment, make sure it is because of a long-term outlook, not because of price movement. Recovering from a stock market loss requires patience. According to Ameriprise, financial comebacks can take years. Based on over 90 years of recorded history, it can take up to 70 weeks for markets to regain the ground they lost in a recent downturn. One of the biggest mistakes investors make is trying to regain the money they lost all at once by investing in overly risky investments. If you decide on investing in long-term goals, you won't need to recover any losses right away. Long-term investors know the market will recover eventually, and create their portfolio accordingly. For example, during the 2008 financial crisis, many investors sold their stocks, but the market bottomed out in 2009. Panic sellers missed out on the recovery, while long-term investors that did not exit the market enjoyed an eventual recovery beyond previous limits. First-time investors can avoid panic selling by understanding their risk tolerance when building your portfolio. Prepare for and limit your losses by diversifying investments into various equities such as individuals stocks, ETFs, REITs and other methods. To conclude, investors should devise a bear market strategy that compensates for different economic cycles. Understanding risk tolerance, limitation of losses, and long-term view of your investments will help build long-term wealth. Thanks for watching. Subscribe, like, and share this video. And hit the notification bell to alert you for more videos.